Very good morning, EBU1063, and my name is Vanessa Lilek Anatini, and I'm going to present about Gilbert's student financial cycle. Well, student phase is a foundation of Gilbert's financial life cycle, where he received 3,800 money from a scholarship and also parental support. He do not rely on student loan, which allowing him to graduate debt-free and also start his career with a strong financial position. He spent 1,400 monthly, which make the surplus as 2,400. He also avoid using credit use. By this act, he understand that the time value of money, and also he plan to invest after graduation and allow him to be ready for the financial future. That's all from me. Thank you.
Next is marriage stage. Shift in the strategy, transition from individual accumulations to collaborative financial management. The focus of this stage is to join the financial discipline, risk protection in the foundation of the building for the shared household. And the key principle of this stage is to maintain the habit of spending below income level to support long-term stability. On the marriage stage, we have two sections, which is stability and protections and growth and asset. For the stability and protections, we have emergency fund expansions. Gilbert target to increase the individual to a, to a joint fund, which is from 4,200 to 16,800. This covers a 6 month of the basic household expenses, which is 4,800 per month, and they planning on purchase of life and medical insurance for both spouse to protect against unforeseen risks. And they utilize fintech tools to having these protections and to manage their expenses. And for the growth and assets, they're targeting to have a home. They target on 35,000 or for 10% of down payment on 350,000 property. This strategy is allocating around 1,200 per month for the surplus to reach our goal within 2.5 years. For the future family, Gilbert starting early with 500 per month in unit trusts or education saving plans. They target to moderate growth around 4 to 6% to combat rising education costs. And for the human capital investments, every month Gilbert invests around 300 for the professional certifications.
So, at the family and working stage, the financial goals become more structured due to the increasing responsibilities. In the short term, the focus is on stability and protection, such as purchasing a home, securing insurance, building an emergency fund, and contributing it to EPF. In the medium term, the goals expand to include the children's education fund, career advancement, vehicle purchase, and building a diversified investment portfolio through unit trusts or ETFs for moderate growth. Last but not least, in the long term, the main objective is financial independence through disciplined savings and diversified investment that generate stable passive income. Overall, aligning the financial goals with different time horizons helps ensure financial stability, growth, and long term security.
Hello everyone, my name is Ruben Russell and my metric number is 106133. And now I'm going to present the retirement stage of Gilbert. So at this point, Gilbert is no longer working out full time. So his main focus shift from earning money to managing and protecting the wealth he has accumulated over the years. And his goals now are to maintain a stable income, control his spending, and protect his savings. The final decision he made during his working years, like contributing to EPF, investing regularly, and managing risks, are really important here because these decisions form the foundation that allows him to have a long-term financial security during retirement. Next is the short-term goals. So, in short term, Gilbert focused on managing his monthly spending according to his retirement income. This includes EPF withdrawals, returns from past investments like unit funds and fixed deposits, and also possible rental income if he owns property. He also shifts his investment towards low risk and easily accessible assets. For example, saving accounts, fixed deposits, government bonds, and low risk mutual funds. This type of investment protects his capital while still generating some income. So it's important that he avoids high risk assets like cryptocurrency, which were suitable when he was younger, but now it is too risky at this stage. Finally, continuing medical and life insurance coverage is essential for Gilbert to reduce his financial stress caused by maybe unexpected medical expenses, which are more common during retirement. Okay, next is for Gilbert's medium-term goals. His focus is on keeping a stable and reliable cash flow for his daily living expenses. He needs to plan his EPF withdrawals carefully and rely on income from conservative investments. Part of his savings should also be kept in cash or low-risk asset because this can act as an emergency fund, just like he did during his working years. And avoiding new debt is also very important at this stage because borrowing during retirement can really create a financial pressure and make it harder to manage his expenses properly. So staying debt free helps to maintain his financial stability. For his long-term goals, Gilbert's goals are focused on preserving his savings and staying financially independent. His priority is to protect his capital and reduce investment risk rather than trying to chase high returns. He can spread his investments across different low-risk assets to create a stable source of passive income. Estate planning is also another key step because preparing a will ensures his assets are distributed properly and protects his spouse and children financially. This can reduce the possibility of conflict or legal issues and ensure that the wealth he built continues to benefit his family. Next is the fintech integration. So first, let's look at the overview. From the overview, fintech has helped Gilbert to manage his finance more efficiently at every life stages, and it simplifies budgeting, saving, investing, and even retirement planning, which overall improves decision making and help him maintain long-term financial stability. Now, during Gilbert's student years, fintech really plays an important role in building good financial habits. So, mobile banking apps and e-wallets allow him to track his scholarship income and daily expenses easily. And budgeting apps help him to plan his spending and maintain a monthly surplus of 2,400. So he avoids unnecessary debt. Digital saving accounts and beginner-friendly investment apps introduce him to saving and investment basics. Even though he doesn't use credit card yet, these tools help him to understand credit awareness for future financial decisions. Next is the marriage and family. As Gilbert moves into the marriage and family stage, FinTech continues to support him and his partner in managing their finances together. So shared budgeting apps allow both of them to monitor their household income, expenses, and saving goals clearly. This helps them to manage their emergency funds, insurance payments, and housing savings efficiently. And they can also invest their surplus funds into unit trusts or education saving plans through digital platforms, which can keep which keeps their savings organized and on track. During the working stage, fintech helps Gilbert to grow his wealth and plan for the future. Online investment platforms allows him to invest regularly in diversified assets like unit trusts and ETF. He can track his EPF contribution and monitor long-term savings, which also support his career growth and disciplined wealth accumulation. In retirement stage, his focus shifts from growing money to protecting it. So digital banking platform help Gilbert to manage his EPF withdrawals, fixed deposit, and other sources of passive income. Budgeting apps help him to control spending so his retirement fund lasts longer. He can also shift his investment to lower risk option and use fintech tools for insurance payments and estate planning to ensure his family's financial security. So, in conclusion, fintech supported Gilbert at every life stage, from being a student years to his retirement stage. So, these tools make his financial planning easier, more organized, and more efficient, ultimately helping him to achieve his long-term financial stability and independence.
Hello, my name is Edo AJ and my metric number is 103 and 907. For this part, financial planning is not static. It evolves as we move through different life stages. At the student stage, the focus is on learning money management, budgeting, and starting emergency fund. When we enter the family stage, prioritize shift to increase savings, getting insurance, and planning for major goals like buying a home and funding education. Finally, during retirement, the emphasis is only protecting wealth generating passive income and planning the estate. Early planning is crucial because it builds security and reduces stress later in life. Across all stages, key strategies include budgeting, saving, investing, and risk management. Emergency funds and insurance remain essential throughout. Fintech tools such as budgeting apps, automate saving, and digital investment platform make planning easier, but discipline and regular review are still critical. Technology support us, but decision and adjustment are personal. Ultimately, the goal is clear: to achieve long-term financial security and independence. For our reflection, working on given financial cycle plan allow us to apply the theory we learned in class to a real scenario. First, we realize the importance of early financial discipline, budgeting, saving, and avoiding unnecessary debt. These are not theoretical concepts, they strongly influence long-term stability. The marriage and family stage taught us that financial planning become collaborative. It requires prioritizing between short-term needs like emergency fund and long-term goals such as children education. In the retirement stage, we saw how the focus shifts to capital preservation, income diversification, and estate planning to ensure financial security for the family. We also explore fintech tools, which make planning easier through automation and transparency. However, we agree that technology is only a support system. Discipline remains the key factor. Overall, this exercise shows that financial planning is dynamic and requires continuous adjustment to life, events, and goals. Our key takeaway is that financial literacy, discipline, and adaptability are essential for achieving long-term security and independence. Thank you.